Hi, good afternoon all. Thanks for staying right before lunch. So today, this panel discussion will be all about bonds. If you're interested in bonds, you should definitely tune in. And if you don't have any bond investments right now, you should also tune in because I think this is going to be a really fun time for bonds and you should definitely look forward to it. So perhaps we could first start off with a recap of bond market performance. Perhaps we could start with Colin.
All right, I would like to first say that if 2023 was a year filled with hurdles for bond markets, 2024 is looking like a year of gradual recovery. And just to recap, in the first 6 months, as you can see from this chart right here, performances across most bond markets were largely positive. So you can see also that some of the segments which with higher yields, like the global high yield, Asian high yield segments, are the strong performers for this year. And this was largely because credit spreads have tightened significantly and was a major driver for the year. So for newer investors, I would like to say that credit spreads can be seen as a barometer of credit risk. So as the global economic growth and earnings growth remains resilient this year, and over the past 6 months, investors start to price in lower credit risk. So what this happens is credit spread starts to contract, and this corresponds to a rise in bond prices. So looking ahead, if you ask me what do I expect this year, we do think that the global economic backdrop remains resilient, and same for corporate earnings growth. So that really supports the backdrop for credit spreads to remain as it is right now. So we do think that this will have two impacts on bond markets. So firstly, we think that credit fundamentals will largely be supported for issuers, especially the stronger issuers. And secondly, we think that bond valuations will remain tight as they have been over the past 6 months. But fear not, because as compared to equities, we do think that bond valuations are still much more better than equities.
Okay, that's great to hear. So supportive credit fundamentals and bond valuations still look good. So I guess turning more to the macro backdrop, with what we see in the US and interest rates, inflation there, I think overall Fed policy has repeatedly talked about data dependence and talked about how inflation will affect how the Fed acts on its policy rates moving forward. But the thing is, if we look at inflation in the US, as you can see from this chart, inflation is still very sticky. So one of the biggest parts of the inflation basket, so it's like 30-40% of the inflation basket for CPI, is shelter. So this is like your housing prices, your rental prices. And based on the leading indicators that we have here, so we have two leading indicators here for rent and for home prices. So these usually act faster than the CPI inflation. So when you see these go up, CPI inflation for shelter generally goes up a few months after. And what we see is that these leading indicators have at least flattened off or gone up recently, as you can see in the red box there. So even though shelter inflation has come down recently based on your CPI readings, we think that it's going to pick up, or at least it's going to take longer for it to come down over time. And apart from shelter, what we also want to highlight is that energy prices is also another big factor. So energy is a smaller part of the inflation basket, but overall it can be very volatile. So you can see from this chart that actually energy inflation can go up by a lot, by about 70% year on year at times. And this is because it's very dependent on your oil prices. You know, if oil prices go up a lot, your energy inflation is also going to shoot up a lot, and vice versa. And with what we see with quite a number of geopolitical conflicts, be it in the Middle East, be it in Russia, Ukraine, I think there's going to be a lot of uncertainties out there, and it's something you have to note. Because if these uncertainties pop up, re-emerge and continue to worsen, what we can see is energy inflation going back up once again. And because of that, I think it's no surprise that we think that inflation will remain elevated above the 2% target. So I think if you've been following US inflation, you might have seen the headlines that inflation has come down from your 7-8% in the US. And to that I say yes, I agree. Inflation has come down from 7 to 8%. Now it's at your 2+% range. But the question is, where will inflation be, not today, not yesterday, but where will it be tomorrow or next year? And I think this last mile of inflation from your 3% to your 2% is going to be one of the hardest things for the Fed to achieve. And if we look at the PCE inflation metric, so this is the Fed has said that they prefer PCE over CPI. So we look at a few PCE metrics over here. We have headline PCE, we have core PCE, and we have trimmed mean PCE. So all different types of inflation. But I think overall, if you look at any of these three metrics, what you're going to see is that your Fed is going to be, your inflation is going to be above 2% target, no matter how you slice it. And based on that, I think what we can expect is that inflation will stay higher for longer, and interest rates by the Fed will also stay higher for longer. But I guess turning back to Colin, so if you think rates are going to stay higher for longer, what type of bonds should you consider?
Right, I think that's really the money question right here. I think what to buy in the event of interest rates, right? So let's move on to the next slide. We can see on this chart right here, the importance of shorter duration bonds. So we like shorter duration bonds for two main reasons. Firstly, I think yields continue to remain attractive at near decade high levels. You can see that from the chart by the left. So right now, if we invest in short duration, US corporate bond index, you are likely to get around 5.4 to 5.5% yield. So this is significantly higher than the 0.5% yield that you may get before interest rate hikes. So that is really a lot more than you can get compared to 1 to 2 years back. So will this continue? I think that is the next important question right here. And yes, we do think that this will continue, and largely because we expect major treasury curve to remain inverted. So what this means is that the shorter duration yields will likely remain higher than the longer duration yields, assuming that credit quality stays the same for both. So the second reason why we like shorter duration bonds is that we see poorer risk reward for longer duration bonds. So absent a Fed rate cut, like what my colleague Cyrus as well as my previous presenters have mentioned, is that without Fed rate cuts, we think there will be little upside for longer term, longer duration bonds, because we expect longer duration yields to see lesser room to fall amidst this current strong economic backdrop. So that would translate to little room for capital upside for longer duration bonds. And again, just to remind everybody that yields move inversely to bond prices. So the next thing to note here is that also, if shown on this chart on the right-hand side, markets are expecting 1 to 2 Fed rate cuts this year, while we're expecting none. And if we are right, we do expect the Fed rate cuts to get pushed back even further. So for investors, what this means is that longer duration yields have potential to move higher. And that also generates price volatility for longer duration bonds, and perhaps also some price weakness for longer duration bonds. So I'd like to bring everybody back to the first 6 months we've seen this year, where your longer duration treasury yields have in fact floated higher from 4 to 4.5%. So that caused a lot of havoc on bond markets, especially a longer duration bond yields. And if interest rates get pushed back, get pushed back even further, we are likely to see that happening all over again. So I think that is one reason why we say that the risk reward for longer duration bonds are right now poorer than shorter duration bonds. So the next important question is, when is a good time to add duration? So in short, we think it is a better time when the major treasury yield curve uninverts and re-steepens, because a normal shaping treasury curve, a steeper one, would in fact, for investors, it gives them a premium to hold longer duration bonds. In short, it gives them higher yields to hold longer duration bonds versus the shorter duration ones. So we think when that happens, and if the shorter end or the treasury yields for the shorter end of the curve remains the same as it is now, around 4 plus to 5%, we think a good reference point to add duration would probably be when the 10-year treasury yields hit about 6%. So that will give investors a stronger premium to hold longer duration bonds, and that would be a perfect time for us to extend duration or to add duration, so to speak.
Yeah, so I guess to summarize, I think short duration bonds is definitely still the play to be. And also what we are waiting for is actually for the yield curve to re-steepen, 10-year perhaps at the 6% target before adding more duration. So I think in terms of some products that you can consider for the short duration, I think we have two products that we think are pretty good. They are your Nikko AM Shenton Short-Term Bond Fund as well as your United SGD Fund. So I think they are very similar. So if you look at their objective, both aim to preserve capital, both aim to outperform some sort of cash benchmark. Duration-wise, both also very similar, 1.22, 1.23. Credit rating, very similar as well. The yield is a bit different, but I think that's more on the way they calculate it. So I think overall these funds are fairly similar. Exposures, you can see Australia, China, Singapore versus Singapore, Hong Kong, South Korea. I think what you can expect from both of these funds is that they are both going to be very Asia focused. They can invest in global bonds, but what you can expect is a lot of Asia focus. And it's also going to be a lot of banks, financials, so that includes insurance as well and so on. So these are very similar funds. Performance track record, also very similar. But I think in terms of what you can expect from these two funds is going to be a high quality short duration bond fund that you can really, I think, invest your money in, and I think feel quite comfortable about it as you put your money in, feel comfortable with that when you withdraw in a year, that I think the likelihood of you making a decent amount of money will be pretty positive. But I guess apart from these two funds, perhaps I could turn to Tea-Ming. Any funds you're looking at yourself?
Right, so taking this opportunity to kind of talk about money market funds again. So do not forget there are money market funds, and if you are cash is king kind of person, whereby you think that, oh, there are better opportunities out there, you are just waiting for the opportunity, you are waiting for that opportunity to come and you need a place to deploy, money market funds is going to be your best friend. So of course on a use basis, your yields are going to be lower than what you see for your short duration. Of course, because you are getting higher yield in exchange for the credit risk you are undertaking. But for money market funds, you are getting a lot higher liquidity while getting minimal risk on such funds. So coming to Singapore in SGD context, one of our favorites is always going to be the Fullerton SGD Cash Fund. This has the lowest drawdown among peer offerings that we have on the on the FSM, on our whole platforms. This is always the most optimal when it comes to SGD, that this is the one that we like the most. Coming to USD, the recent favorite we have been looking at is Amundi Funds Cash USD. So if you are looking at, you have additional USD to deploy, you are still waiting for the opportunity, this will be the best option. Something even better, don't forget our auto sweep. So auto sweep wise, right, of course, auto sweep catering to maximum liquidity that we can give you within our ecosystem itself, right? If you are looking at instant deployment of your investments, this can achieve T+0 for your buying and selling of investment securities. So for auto sweep, we do look at a slightly lower yield, but this will offer the best opportunities. In case you are a cash is king person, the auto sweep will really be your best option to look at.
So yeah, I think there's quite a number of options out there. There's obviously these two, Nikko AM and United SGD Fund. You have your money market funds as well. I think all of them are very short duration bond funds that you can consider. But perhaps apart from short duration and money market, do you have any themes in mind, Colin?
Right, I think if you can move on to the next slide, you can see that quite clearly these are just very good, very quick reasons why we like higher quality bonds. So since the steep global rate hikes, I believe 1 to 2 years back, the borrowing costs for companies have risen tremendously. And this is very taxing on the issuers, both high-yield issuers as well as investment-grade strong issuers. However, as we believe interest rates stays higher for longer, this will exert greater pressure on the weaker, higher-yielding issuers, given their weaker corporate fundamentals, weaker balance sheets. So for high-yield issuers, the amount of maturing debt itself is expected to climb over the next 2 years. So as shown on this chart right here, we do expect a maturity wall hitting as soon as 2025. So this simply means that we are expecting greater financial stress when companies need to repay their principal of maturing debt, or when they are expecting to refinance, likely at a higher cost because of the higher interest rates environment right now. So let me give you an example. So when we look at the S&P Global, they have estimated that for BB rated US corporate issuers, when they want to refinance their debt maturing in 2024, they are expecting higher coupons of 2.4%. So for investors, that may be a good thing to hear. But for companies, this is more taxing on their balance sheets. So this will exert greater financial stress on the higher yielding issuers. And also, as shown on the chart right here, when I talk about vulnerabilities, we are also seeing greater vulnerabilities across the high yield landscape, so to speak. So for example, looking at the default cycle on global high-yield bonds, we can see that it is in fact underway as the trailing 12-month default rates have risen from a low of 1.4% before interest rates were raised to around 3.9%, which is above the 10-year average. So let's move on to the next slide where you can see that a slide back, yeah. So this is a concern for us because when we look at the credit spreads of high-yield bonds right now, we find that it has compressed rather drastically. So earlier on, I mentioned credit spreads. So you can think of it as a general barometer of credit risk. So we saw this compressing rather significantly. And right now, for example, it's trading about 387, 388 basis points as compared to the historical average of 530 basis points. So why do this number make sense? It tells us simply that high-yield bonds are trading at very tight valuations, very much below its long-term historical average. And in fact, there are two things we can learn from this. Number one, high-yield bonds are expensive at the moment. And number two, high-yield bonds themselves, or bond markets themselves, are in fact too optimistic on high-yield bonds, resulting in these tighter valuations due to the greater demand, and they are perhaps underpricing the risks that I mentioned earlier. So on the other hand, when we look at global investment grade bonds, we generally find it cheaper as compared to high-yield bonds. So while spreads for global IG bonds have tightened a little bit, we generally find that it has been less drastic, and in fact, global investment grade bonds on aggregate are still offering attractive yield at about 5%, which if you look across history, that is one of the highest over the past 10 to 18 years. And in summary, those are these two reasons why we think, or we lean towards the stronger credit rated bonds.
Yeah, absolutely. I think as Colin has mentioned, currently your high-yield bonds, currently the risk-reward isn't there for us right now compared to investment-grade bonds. And if you agree with us, I think one fund you can consider is the Allianz Global Opportunistic Bond Fund, or GOB fund. So this is a all-weather bond fund, which means that it aims to perform in all weathers, in whatever market environment. And I think what you can expect from this fund is that most funds, global bond funds out there, they focus a lot on your bottom-up credit selection. So picking the best companies, the best bonds on an individual bond level. But what this fund does is different. So what you can expect from this fund is a more top-down fund. So they have macro views on, let's say, your interest rates, inflation, duration, and so on. So you can see I took this picture from the materials. They have a lot of potential levers to generate returns. And you can see that they're all top-down based rather than bottom-up. And yep. And if you look at the holdings, I think it's also very different from a lot of your global bond funds out there. So a lot of your global bond funds out there, they focus on your corporate bonds. But you can see that this bond, if you look at this is taken from their latest fact sheet that I extracted yesterday, and you can see that it's mostly government bonds, US bonds. And what they really do is that they once again play around on a top-down level. They can play around on your duration inflation. For example, part of their US government holdings, they invest in your TIPS or your Treasury inflation-protected securities. So they are sort of tied to your CPI inflation, and it's really a play on how US inflation will go. And you can see that overall, if you're looking for a high-quality bond exposure, this is going to be your fund because the average credit quality of this fund is AA-. So that's very high. That's just below, your just below a AAA, AA+, and AA's. And if you're looking for a really high-quality bond fund, I think this is what you really want to consider. But I guess turning over to the Sing dollar bond market, we have talked a bit about high-quality, short duration. Di-Ming, could you perhaps take us through the Sing dollar bond market?
Right, so just a very quick summary. So what we have seen for the year-to-date performance in the Singapore market, the Singapore government bonds broadly fell by around 2% over the first half of the year. Meanwhile, your corporate bonds, they were quite strong. They performed about plus 3% just from this half year alone. So what mainly happened, I think you're already aware, we do see quite a huge adjustment in the rate cut expectations. Previously from 6, it adjusted downwards to this 1. So we did see a very strong rebound in the yields on the Singapore government bonds. This simply led to mark-to-market losses on the Singapore government bonds, leading to the 2% loss that you overall see. On the other hand, for Singapore corporate bonds, what is so different for Singapore corporate bonds is that we do see a very strong tightening of credit spreads across this year itself. This strong tightening of credit spreads, right, it offset the entire yield adjustment or the mark-to-market losses, allowing you to see this 3% gain. How good was the corporate bonds? For this year alone, because of the low yields overall, especially at the start of the year, we do see more than double of the issuances just from this half year alone as compared to last year. Even until now in July, we are still seeing very strong flow of issuances. The majority of these issuances, looking at the top 10, 7 are financial institutions, 6 are major banks or local banks. These are very good names to actually look at. Yeah, so continuing very quickly into what we recommend for bonds overall in the Singapore market. So we probably look into 2 categories, one being the financial issuances. These are investment grade, typically, or bank bonds. Why we still like bank bonds? Previously, we have already talk about how much we like bank bonds given a strong performance. It has performed really good because of the high interest rates environment. Most banks really earn a lot of their banking business activity. Even until now, we do see some depression in the net interest margin for those banks, especially if you see across the local banks, DBS, OCBC, UOB, you will see this. But overall, the entire revenue, the entire profits coming from a banking business is still extremely high. And we do believe this will allow for the banks to continue to have very good performance in the years ahead. Coming to the other section, for the non-financial issuances, these are some of the issuers, right, that we have identified. These are the ones that we really like. So these are the attractive yielding. Some of them are pretty short in duration, so you can actually compare them as good alternatives to T-bills. For Olam and Thomson Medical, these 2026 and 2027 paper, these are the one of the better yielding papers among the high yield space in the Singapore debt right now. So offering close to about 5%, these are one of the better options that we have identified. So for Thomson Medical 2025 paper and also ESR 2025 paper, these 2 are good alternative to T-bills in case you are looking for a little bit of higher use, but at the same time, you do know that you can take a little bit more credit spread as compared, credit risk as compared to what is offered by the T-bills. Yeah, so that's for me.
Yep, so I think we have talked about quite a number of products. So if this is time to take out your phones if you are looking at what recommendations we have. So just a recap, in terms of the bond fund space, I think we have a number of short duration bond funds, your Nikko AM Shenton short-term bond, your United SGD fund. If you are looking for high quality exposure, you have your Allianz GOB fund. And as Teeming just mentioned, within the individual bond space, there's also a lot of options out there. Within the financials, you have a lot of high quality ones like your Commerzbank, BNP, and Deutsche Bank. And for your non-financials, we also have some short duration options from your Olam, Thomson Medical, and ESR, for instance. So I guess before we end today's panel, perhaps I could ask my 2 panelists to come up with one takeaway each. Perhaps we could start with Colin.
All right, maybe I'll start off first. I think the biggest takeaway from me to you is that you can think of 2022 and 2023 for bond markets as a major reset. So right now, we think that the reset is done. We think that the performance for bonds moving ahead is likely to turn the tide and improve. So I think that is my takeaway.
For myself, very straightforward. In case you're an SGD bond investor, you're still waiting out, sitting on the fence, thinking, oh, when do I enter? Now is the best time. We have been looking at a whole galore of options since the start of the year. The issuance is still coming in strong. This will be the best time for you to start looking and start finding your options in the SGD bond space.
So yeah, overall, Colin has said it's a reset for bond markets, and as Teeming has said, it's going to be a lot of options out there in the Sing dollar bond markets. I think for me, I think this is one of the most exciting times for bonds. Yields are at levels that we have not seen in the past 10 to 15 years. And I think, as my panelists have mentioned, this is not a time to miss out on the many bond opportunities, bond fund opportunities out there. Thank you.